Thank you for joining me this afternoon. I'm sure I've met many of you. If you haven't met me or not familiar with me or Cleveland Research, a quick intro. Cleveland Research is an investment research firm. So, we do research across a variety of industries that we ultimately sell to institutional investors to help them make investment decisions. But what makes us kind of unique is our research approach. Rather than just being economists and looking at macro signals like interest rates and labor, unemployment, things like that, we really pride ourselves on what we call channel work, which essentially means networking and connecting across the industries that we do research on. Within the fluid power industry on a regular basis, I'm talking to a lot of you here on the call, talking to distributors, talking to the suppliers, trying to identify key trends that are happening on the ground from the people kind of living and breathing in those trends. Um, and then we, summarize all those insights into like actionable insights for investors. But that same info that those customers of ours are paying for, we have also, we package into industry insights that people in the industry are using. And, we've had a long-standing relationship with FPDA and running their trend survey. So I would do want to take a quick minute here to plug this survey. If you are not participating, I strongly recommend that you do. The better the input that we get, the better the output that you guys get. And, the online survey is really helpful as well, but also, we love talking to you guys as well. I think, the data can be really valuable, but the conversations can really put a lot more meaning behind what's happening with the data, why it's moving the way it is, explaining how tariffs are impacting things, how COVID impacted things. The conversations can capture a lot of the trends that the data can't quite capture. But if you aren't participating and you're not getting the emails on a monthly basis to participate, please let us know. We want to make sure that you are getting all the info and the results. And we find that people find them really helpful for understanding what's going on in the market, benchmarking their performance, and really, I think people are ultimately using this for the forecasting. That's what we're going to do today. We're going to kind of give a brief overview of the macro economy, talk about what the year of 25 looked like in the fluid power industry, and then talk about our outlook. Should be around 30 to 40 minutes. We tried to shorten the bit on the macro side here. Don't want to kind of drone on too much about some of the stuff that's not specific to your industry, but yeah, with that, we'll kind of get into it with the macro economy. Here we go. Yeah, but I think a good place to always start and kind of one of the best gauges of the overall macro economy is looking at unemployment. Um, Here you can see the unemployment rate. I always think what's interesting about the chart, the COVID spike to record highs, worse than what we saw during the Great Depression. But since then, it's bottomed. It has creeped up over the past year or so, from bottoming in the low threes percentages, moving up to about 4.3, 4.4 recently. You have seen a lot of layoff headlines, just given weak demand, the consumer's under a bit of pressure. More companies are responding to that with layoffs. Additionally, we're seeing a lot of companies investing in AI. And in order to do that, they have to show returns. So we're seeing companies make SG&A cuts in order to do that. So we are seeing unemployment creeping up. We do think that this is going to creep up further through 26. Our macro team, who is using our channel insights from all of the industries that we do research on, thinks it's going to peak out at around 4.5% next year. So still a relatively healthy market. Nothing like too concerning. Like if you think back to the great financial crisis, we saw it get all the way up to 10%. So still near the low, but moving in the wrong direction here. The other key topic that I think, and why consumers are under pressure is inflation. Um, Still above the Fed's targeted rate of 2%, hovering around 3% right now. The biggest component here is the tariffs driving a lot of price increases, inflation. We've seen within the fluid power industry itself, lots of price increases throughout the year, more than usual, and some of these much larger than usual as well. With labor getting worse and inflation still above the target, it puts the Fed in a pretty tricky situation. Their job is to kind of manage these two metrics, make sure inflation doesn't become runaway, but also make sure that, by limiting inflation, they're not having too detrimental of an impact on the labor market. Um, so our macro team, looking at all of the conditions that they're seeing, looking at what the Fed is seeing, while the consumer is under inflation because of the tariffs and the uncertainty, they're under pressure. They have slowed spending. But if you think back to April when Liberation Day first happened, there was an absolute panic in the market. When we were talking to people across the fluid power industry, they were like, "Hey, our sales are going to be down well into the double digits. This is going to be horrible. We're going to have to do tons of layoffs." Um, but the actual results of the tariffs has actually been much more subdued than initial expectations. It certainly has caused a lot of headaches, a lot of inefficiency. I'm sure many of you guys have spent lots of time in meetings talking over tariff headlines just for them to change the next day. But when you look at the core like metrics that we're gauging the economy on, things have not been as dramatic as initially feared. Like I said, that inflation, up around 3%, but not run away. Employment is moving in the wrong direction, but not drastic at this point. And I think what's interesting is like the retail sales have held up really resiliently. A lot of that is being driven by the high-end consumer, but overall, like not in a large recession like initially feared at that time. With that in mind, though, the Fed, so here's kind of where our macro team comes out for their forecast for the next few years. And if you look at GDP, kind of the overall gauge of economic growth, looking at around 2% growth in 25, we're going to wrap up around 2%, pretty in line with historic trends and, a little bit softer in 2026. But not dramatically so. So things continue to grow despite the uncertainty and the inflation rates. But as you can see, if you look at the bottom of this table here, um, more interest rate cuts are expected. The Fed is expected to do their third cut here in December, which will bring the rates down to about 3.5 to 3/4. And then we're at the current situation based on where the economy is today. We expect two more interest rate cuts in 2026, which should bring the Fed rate to around 3%. So overall, not a super robust economy, but things showing quite a bit of resilience in the face of what initially was some very scary tariff headlines. But jumping into the industry that you guys all live and breathe every day, we're going to talk about what the trends we're seeing through the survey, and this is based on all the results that we get from you guys and from your members. So this is what's going on in the world that you live in. If you've been on my webinars before, you've probably seen this slide. It looks just a little bit different on the right end, but I always think this is just a really helpful slide that kind of paints a little bit of, or gives a little bit of a history lesson of what's kind of driven and moved the industry demand over the past few years. Starting in 2016, you had the oil and gas recession when oil and gas was a much larger part of the overall fluid power industry. But then once Trump won, there's a lot of optimism around a more pro-business environment. Tax cuts, depreciation on the capex drove more spending, which saw a pretty meaningful acceleration. And then, as you can see, in the middle of 2018, that's when things started to peak out with tariffs, which we know cause a lot of uncertainty. Less so the cost, but more the volatility around it. The hesitation it gives customers when they don't know what their world is going to look like. That slowdown continued as the tariffs escalated. And then 2020, obviously, it's nice to not be talking about COVID in these webinars anymore, but saw a huge drawdown. And then a sharp recovery. I think the world figured out that they could operate really well remotely, and we saw a drastic, sharp recovery, really strong demand. A lot of that sales growth, though, driven by the inflationary environment, tons of price increases tied to the supply chain issues and the inflation, which peaked in the middle or early to mid 2022. As a result of that, the Fed had to cut hikes or cut rates as you saw the industrial economy slowing. And then I think, looking at more recent and coming into this year, if you remember in November when a lot of you guys of 24, when a lot of people were doing their budgeting, throughout 24, there was tons of uncertainty, political concerns. what is the world going to look like. When Trump won, there was a ton, politics aside, there was a lot of optimism in our conversations. People were excited about the pro-business environment. They had pretty bullish expectations on what 25 would look like, thinking that you'd see, further tax reductions, more beneficial CapEx environment. And a lot of that optimism was quickly washed away with the tariff environment, particularly Liberation Day. So while we did see, we have seen recovery throughout the year, it has been much more subdued than anticipated, and we'll kind of talk about that in a little bit more detail here moving forward. Um, as you can see, this is kind of zooming out, looking at sales. The blue lines on the left chart are the monthly sales. The orange line is that the monthly sales smoothed out. Things bottomed in November of 2024 with the optimism around Trump. What I would tell you is the rate of recovery was much more subdued and slower than anticipated. In my conversation, so I've been covering the industrial economy for about 10 years now. I would say like this year has been the year where there's been more volatility, the least amount of consistency between my conversations. A really good quote from a distributor I talked to. He said, I feel like things are turning a corner this month. He's like, but I've told you that 4 times this year. Lots of comments on, you get 2 good months in a row, then things take a step back.
Right.
And
I got it. No, I got it right now. I had to switch my to the different pair of speakers and turn it so I can turn them down.
Brian, could you? Oh, there you go. Thank you. So a lot of that volatility was caused by some of the uncertainty because of the tariff headlines, which were constantly changing, moving in and out. So people were hesitant to pull orders. What we consistently heard was there's a lot of orders in the backlogs, a lot of quoting, but people just aren't willing to move forward with those at this time. The chart on the right shows the expectations or its performance versus budget. I do think this chart is a little bit misleading. Everyone did their budgets in a pre-tariff environment, so had really bullish forecasts. So while most people were missing budget throughout the year, within the conversations, people were like, "Yeah, we're below budget. We're not seeing the optimism that we thought coming into the year." But we're actually, we're not seeing things fall off like we initially feared around Liberation Day. So volatile month to month, but it is moving gradually up in the right direction. And I think this chart is pretty encouraging as well. This shows that same sales line, but lays it next to orders. And orders have actually outperformed sales now for the last 7 months, which is really encouraging. And with that, you've actually seen backlog start to re-enter expansion. So while we were seeing a lot of choppiness and volatility, and there was like no consistency or belief that that would turn into a more meaningful, stable recovery, we're starting to get more confidence that this trend line, both on the sales and orders, can continue to move further up and to the right, especially as backlogs, start to grow here. Looking at channel inventory, not a ton or not a really big story here. If you think back to COVID and the supply chain environment, there was massive blanket ordering, double orders. People were trying to make sure that they were getting allocation, and that created a huge inventory glut in the field. And we saw a lot of that destocking and that inventory drawdown throughout 23 and to a lesser degree into 24. That's the blue line manufacturers significantly underperforming distributors as distributors work through that inventory. You can see the choppiness in the recent months, but you can also see that distributors and manufacturer sales much more in line. Not seeing excess inventory at the distribution level. They feel pretty comfortable, but they also aren't in a spot where they're confident enough to start placing stocking orders at this time. Also, a little bit more confidence in the field that supply chains have right sized. They've corrected since COVID. People feel more confident in their ability to get product quickly. So there's less need or desire out there in the field to start ordering ahead unless they see a much sharper recovery than they're anticipating, and we just aren't seeing that yet. One thing though that does stand out to us on the inventory front that I think is notable is on the left, this is a measurement of inventory at the distribution level versus the prior month. And as you can see, both of the last 2 months, distributors have seen inventory move up. But while inventory has gotten higher at the same time, the inventory too high metric is not gotten worse. So people, maybe placing some early signs of stocking orders, feeling a little bit more secure in the stability in orders they're seeing. So seeing inventory starting to creep up in preparation for better demand. And it's not, people aren't worried about having excess product on the floor. So, expecting to see distribution and manufacturer sales and orders move relatively in line throughout 2026. Uh, I think when we talk to people, the biggest question we always get is like, where are the markets of growth? What are the end markets that are weak? And where are the new kind of opportunities? What are the end markets that are growing? So I'm going to dive into that here. But first, here's an aggregate of all of the of all of the 17 end markets tracked in the survey. As you can see, really like volatile over the past, year or so. Big spikes up and down. What is notable to call out is October also saw a contraction in this index, and that would be the start of the seventh consecutive quarter in a row where this end market index is contracted, which would be on pace or in line with the record amount of time where we've seen no growth in this survey. The last time we saw that was the second quarter of 2015 throughout 2016, tied to the oil and gas recession. So definitely not a good thing to see that, it's been down and weak for this long. But what's encouraging is that, history, if history continues to repeat itself, things pointing to this being the last quarter where this is going to contraction and should start to enter recovery here moving forward. Now, this is taking a look at where each of the individual end markets that we track are today in October, at the ending of October of 25, and comparing that to October of 24. A pretty clear trend here. We have seen improvement and or stabilization in a lot of the markets on the higher end of the screen, and it's not surprising if you look to the bottom to see heavy industrial, oil and gas, and particularly ag way at the bottom. So we'll dive into each of these a little bit more, but heavy industrial markets have been kind of the drag on the overall industry, and where most of the conversations that we have, it's always, hey, like things are choppy and underwhelming, but ag is, at an absolute bottom. If it wasn't for ag, our sales would be 5-10 points higher, just given how weak and the magnitude of the declines with those end markets. Here's just kind of taking a zoom out, looking at each of the end markets individually relative to how the overall aggregate of the indexes is performed. Ag at the bottom right there, as you can see, significantly well below the average. And you can take your time and look at each of these individually, but we'll dive into ag here specifically. So yeah, here you can see that, massively underperforming the aggregate of all the end markets that we track. What is encouraging is it seems like we've seen the bottom. Things do not appear to be getting worse, at least from a year-over-year rate of decline. We still are seeing declines, but the rate of those declines is becoming less severe. So bouncing a bit along a trough here. What is concerning though, and not really positive news here, dealer inventory in the channel still significantly too high. Our team here that covers the heavy ag and industrial markets does a dealer survey where they're talking to all the ag dealers across the country, and they measure their inventory, and 93% of those distributors still saying they have too much inventory. So with this in mind, ag is still expected to be weak heading into 2026. That team here at Cleveland Research just did their recent ag dealer survey where they talked to all the dealers across the country, and they asked for their initial outlooks on what 26 sales growth would look like. And the expectations is still for a decline. Pretty wide range here at down 0 to 10%, 5% at the mid tier. But coming into this year, a lot of people were hopeful and optimistic that 25 could be the bottom. Seems like 26 is really going to be another year of declines, and where we do find the bottom. Some of the factors there, one, the ag dealers heavy on inventory, the tariffs, with China causing them to not buy the soybeans. So this is among the worst end market, and is expected to continue to be the worst end market heading into 2026 here. I think the market that, versus expectations was the most underwhelming in 25 was certainly oil and gas. Within a lot of the initial optimism coming into 25, people continuously called out, hey, like we think that oil and gas is going to see a sharp recovery in 26. Trump's drill baby drill, mentality, people were very optimistic about. And while you can see like oil and gas is actually not significantly underperformed the other end markets versus expectations, I think this is the market that has just been more underwhelming. We haven't seen a recovery or a ramp up here, and it doesn't really seem like there's one on the horizon with oil still or WTI in the $60 range. And one more bad one before we hop into the positive ones. There are some bright spots here, so I don't want to just be delivering bad news. But automotive has been pretty challenged. This is an area, though, I would say where in my conversations we hear more mixed feedback. Production has actually held up relatively well versus expectations throughout the year for this industry. This is, an extremely complex supply chain. Tariffs, wreaking havoc on probably this industry more than any other ones. We have a team that does a specific focus on the automotive industry, and it's just crazy the amount of back and forth, the efforts to reallocate, reclassify products, try to work around tariffs, to the point where the OEMs aren't even really sure what the auto OEMs aren't even sure what their actual tariff impact is going to be. And we haven't really seen them passing any increases through. That is expected in 26, so we are worried about end demand heading into 26 as these OEMs do have to offset some of this tariff pressure they're facing with price increases. But another thing, because of the uncertainty, a lot of these guys have not done any line changeovers to their new model years. And a lot of, the fluid power, the consumables, the MRO type product, they haven't seen the benefit from those line changeovers. So a market that we think is going to continue to be challenged here into 26. One market that continues to be the most resilient, and I think, it has taken a little bit of a step down here, but with the 3-month moving average recently, but think that this is going to reaccelerate here, is just the MRO repair in the facilities. And as like we start to see orders, become more stable, sales ramping, companies seeing their customers get busier, the optimism is that, production is going to ramp up. This is going to drive more activity and drive more MRO spend. So always an area of our survey that's outperforming, and expect that to continue to be resilient and reaccelerate into next year. Also seeing a stabilization on the consumer markets, looking at food and bev and life sciences. These holding up well. Like I said, the consumer individually under pressure, but overall consumer spend holding up pretty well. REITs, especially driven by the high-end consumer. So within our automation work, seeing lots of good spend here. So think these markets are going to continue to be positive and resilient throughout 26. And then aerospace, this is an area that, especially in the aftermarket, we've seen a ton of strength. I know, some of this goes factory direct, not always going through distribution, but this is an area that continues. Anyone with exposure here sounding more optimistic, starting to see as Boeing is making recovery, starting to increase their output, seeing better spend across both the OEMs and the aftermarkets within the aerospace industry, and think this is going to continue into 26. The area of most optimism, and that's becoming a really meaningful opportunity, is data centers. You guys, I'm sure, have, obviously are all talking about AI on a regular basis. That is driving a ton of spend on data centers. But why that's becoming more meaningful for the fluid power industry is because of this chart here on the left. So this shows the amount of power that is used in each of the NVIDIA chips, which the NVIDIA chips are the key kind of, engine of AI essentially. But each new generation of chip is putting out higher levels of heat output. And because of that heat output, in a traditional data center, you just use traditional air conditioning to cool those data centers. But as the heat output is ramping, you're having to use alternative solutions like liquid cooling to cool those racks. So that essentially means bringing literally water fluids, dielectric fluids into the racks and running water onto a cold plate sitting on the chip directly. So as you start to see these new chips, which are called NVIDIA Blackwells, that require liquid cooling being installed, we're starting to see significantly higher amounts of PVF, hoses, connectors, valves, being installed in data centers. Still trying to do a better job on our end of quantifying what this opportunity could look like. Here's the chart on the right shows a summary of liquid cooling from Eaton's, one of their they recently acquired a company in the liquid cooling space, and they gave an estimate of what they think the liquid cooling market could look like. Currently seeing it as $2 billion. Expect that on the conservative end to go to 2 billion with optimism, that could be as much as a $10 billion market. I think what's crazy though around this is just the conversations we have around the opportunity in data centers, talking to the distributors in the field who are like, hey, we've never done a data center. We worked with this data center customer. We thought it was going to be a $5 million order. Turned out to be a $20 million order, and they want to do 5 of these over the next few years. Guys calling me saying, hey, we just got a $30 million order. We're hearing issues on hose capacity for certain SKUs. So think that this is an area that continues to be very strong. The comments we're hearing on the hoses, connectors, and valves today remind me of some of the comments that I was hearing on the HVAC industry 3 years ago. For context, so I also do research on the HVAC space, and when these data centers first started being built and they were using air cooled, you would talk to a rep or a distributor who was historically selling into schools and hospitals, and a large order for a chiller or air conditioning system in an environment like that would be $1 to $2 million. We're now hearing these hyperscale companies like Facebook and Google placing orders for $500 million of chillers. Spoke with an individual who sold over $1 billion of air conditioning equipment in 1 year. So just a massive amount of opportunity and spend in this industry, still in the early stages. Parker Hannifin, one of the large suppliers in the industry, publicly sized it up as only 1% of their sales, but think it seems to be growing very rapidly, and think that this is going to be a more attractive market across the space. So if you are not thinking about data centers or involved with them, this is certainly a market that I would turn your attention to. And then just want to talk, going through the end markets, just also want to talk about, a big impact on sales this year, which has been the inflationary environment, given all the price increases. We saw the annual prices coming into the year, but with tariffs, we saw lots of price increases from suppliers announced throughout the year. Some would do it on a regular basis, announcing over several increases. Some would try to hold off and wait. Some, applied them immediately to the backlog. But in aggregate, the overall actual impact on distribution sales from price increases, not as high as we initially would have expected. Really only seeing around 2 to 3% contribution to sales growth from inflation. Some of the big headline numbers that, with price increases in the 20% or 30% range were generally on, lower volume SKUs. And then a lot of the, OEMs, really pushed back on some of these price increases. So overall, we did hear that, price, a meaningful contributor to growth in a year where volumes weren't providing much, most likely volumes actually down in the year. So any of the year-over-year growth really being driven by price. One thing I would call out, though, in this environment, we did hear that the amount of competitive pressure has ramped up across the field a lot, as customers are slower to move, not really pushing projects forward. They also have more time on their hands, which is allowing them to shop around a lot, price check their suppliers, get more competitive quotes. We've heard a lot of people talk about really elevated quoting activity, but not seeing as good as order conversion on that level of quoting. And a reason for that lack of conversion, one, is just the uncertainty in the market. But I'd also attribute that to the fact that a lot of people are really just price shopping around. Some of these quotes are jobs that people are getting first, second, and third looks on to get more competitive offerings. So we have heard distributors highlight some margin compression despite the price increases, just because they're trying to, be more proactive in defending their share, or have to be more aggressive to go after share. But we expect this pricing environment to kind of normalize as we head into 26. The tariffs largely smoothed out. They are in the Supreme Court right now. But even if the tariffs that are being debated in the Supreme Court are the reciprocal tariffs, So even if those are pulled back, we still do have the tariff impact on the 203 tariffs, as those are sanctioned by Congress. So we do expect, more price increases heading into 26, but those on average are expected to look like more historical pre-COVID type price increases in the low to mid single digit range, with expectations for another 1 to 2% contribution to total sales growth in 2026. So that brings us to our overall, forecast for what next year is going to look like. If you remember coming into this year, a lot of optimism. You can see that the blue line here is the progression of how people in the survey were thinking about 25 growth. There was a lot of uncertainty in September and October ahead of the election. Trump won, a lot of optimism. And then you saw that, kind of flat line and actually work its way down as the recovery throughout 25 was underwhelming. But people feeling a little bit more confident here in recent months. The initial outlook for 26 for mid-single digit growth, 4 to 6, so, midpoint of 5% growth in 26, with the expectation that the majority of that growth is going to be back half weighted. From our conversations, what we're hearing is that, people, based on order books and backlogs, what's expected to ship out in the fourth quarter, into the first quarter of the year is expected to look pretty similar to the trends that we're seeing in 3Q. So, expect a little bit more of the environment we're in, but then we're, confidence that as rates come down, tariff uncertainty clears up a little bit, that, there's going to be more confidence and acceleration and growth, getting closer to that high single digit range in the back half of the year. Breaking that out across price and volumes, again, you can see here, some of that growth is going to be coming from price. I think it's going to be around 1 to 2%, but the bulk of the growth is going to be driven by the volumes here, especially in the back half of the year, as the price increases start to moderate and fade against the tougher comps from the increases this year. Looking at kind of a upside, downside case here, more optimistically, we think things could kind of enter that high single digit growth range for the full year. In this environment, what we see is a lot more clarity and uncertainty around tariffs, more or a quicker path to lower rates, and just overall increased confidence in the economy. The biggest thing that's been weighing on a lot of things is the uncertainty around tariffs. What has us more cautious, or things that we're looking for as a risk, is if these tariffs do not get rolled back. While we're hopeful that people have kind of acclimated to this level of uncertainty, USMCA is up for renegotiation in 2026. Given Trump's past, certainly don't think there's going to be a calm or peaceful negotiation here. Would expect a lot of volatile headlines there. So in an environment where we see tariff volatility continue, think growth kind of stays flatter in a low single digit range, call it 2% growth. But where the reality where we think things fall is somewhere in between. Still expect some tariff uncertainty. What we've heard from a lot of our conversations is that customers are essentially growing acclimated to the level of uncertainty. We had a really good conversation, and just kind of a simple anecdote, but he said, coming into the year, customers and, the industry was optimistic, like an 8 out of 10 level of optimism, with the expectations there'd be pro-business administration. And then tariffs destroyed that confidence and sent it down to a 2, as people were panicking that tariffs would really be detrimental to their business. That confidence, we've heard, is like kind of moved back up, to 6. So not quite, back to this level of optimism, but hey, like, these tariffs weren't as bad as we thought. We're feeling good. We're kind of used to this level of uncertainty. We can't continue to bank our decisions off of the next Trump headline or tariff headline. We're going to have to start pushing some of these jobs through. And that's what is, helping us get back to growth here as we head into the next year. So, a pretty choppy, inconsistent year that we've seen here in 25, but thinking that things are going to continue to improve, look a little bit more stable. So what I would tell you is, plan for more of the same. There is going to be a recovery. It's going to come in the back half of the year. The 5% growth, with only a few points of that coming from volumes, not super robust. So if you are looking for stronger growth than that, it's going to have to come from area of either one, moving to the areas of outgrowth like data centers and aerospace, or taking it from share. And the other thing I would be careful of is just not to be too reactive to 1 month of trends. We did hear like of one, distributor we talked to, they got a really large order, started placing some stocking orders, then some orders didn't repeat. So like, make sure you see, a few months of consistency from your customers before, really changing your overall macro outlook or how you're thinking about your business. And then inventory, pretty normal situation. Don't see too much inventory in the channel, so not worried that people need to tighten up here. But also, like, we need people I think have been really tight. If things recover, don't be afraid to start to place some orders here. In a world where market share is going to drive outperform, like, is going to be important. I would say, having inventory and good service levels is always going to be helpful. But yeah, overall, following a pretty uncertain and noisy year, I think things should stabilize and kind of return to a bit more of a normal environment. With that, I'll open it up for any questions here. No questions?
Wow, that's a quiet group. Does anyone have any comments or questions?
All right. Well, thank you guys for joining this afternoon. Just one more plug for the survey. Would love to get you guys to participate. The better the input, the better the output. Think it's a really helpful resource for members. It's free. So yeah, just would really recommend. Got some questions coming in here. Bill, we have not heard any of those issues come up in any of our conversations. Bill asked if we're hearing any chatter around regulations, around compliance issues, around REACH, Prop 65, and other things like that. That is not something that's come up in a lot of our conversation. That's certainly something that as we go into our next round of checks and conversations, we can ask more and get some feedback, and we can include some color there in the output of the monthly trend survey. Awesome. Well, I think that's it on my end. Thank you guys for taking the time to listen in.
Yeah, and thank you so much, Owen. This is great information. Everyone appreciates it, I'm sure.
Thanks, Owen.
Awesome. Have a good one, everybody.
Thank you.
Thank you. Will you be providing this presentation to participants?
Yes, I will. I am recording it. So I'm going to turn that off right now, and you will find it on the website. Hopefully by the end of the day tomorrow. Just go to the education tab and select on the drop down on demand.
Okay. All right. Thank you ever so much. Appreciate it. Very helpful information.
Thank you.
Thanks, everyone.